Wall Street, top investors watching your money. Joining me right now is Slate Stone Chief Market Strategist Kenny Polcari, TJM Institutional Services Director Jim Urio, and the Fitz-Gerald Group Principal Keith Fitz-Gerald. Gentlemen, Merry Christmas to you all. Great to see you. Thanks for being here. Keith, kicking things off with you with markets that are edging higher this morning. What a big rebound on Wall Street yesterday. As we take a look at the third quarter GDP this morning, that's coming out at 8:30 a.m. That's in an hour and a half. The expectation is for growth of 2.1%. That is a sharp slowdown from the 6.7% growth that we saw back in the second quarter, Keith. What happened? Things slowed down quite a bit this year, didn't they, by year end?
Well, it is, going to be a slowdown. We're going to come into a contentious Fed in January or February. I think that people have to be conscious of that. You got to pick your bets carefully. So to me, I think anything that's a positive number is going to be good. I'm not so concerned about the number itself as much as I am about the reaction to the number.
What kind of a reaction would you expect if we get a 2% handle?
Well, here's the thing, Maria. It's all about the perception of what the Fed's going to do next. If the number is really hot, then everybody's going to perceive the Fed is going to step in, be aggressive, raise rates faster, et cetera, et cetera. We've seen this playbook before. The market may react negatively to it. If the number is just right and it's Goldilocks-like, then I think we go off to the races. There's still a lot of growth. Companies like PayPal, Apple, Tesla have all got great numbers coming down the line, and the markets are simply throwing those out the window right now. So I think we very quickly get back on the gas if the number's correct.
Yeah, meanwhile, inflation is still a major issue, Jim. European electricity bills skyrocketing amid concerns over the recent surge in COVID cases. Every country except Poland and some of the Scandinavian countries recording a price of over 300 euros per megawatt hour for the coming week. What's your take on this, and what does it mean for the oil market?
Well, it's a cautionary tale for us, because if you look at the ingredients that went into causing this, it's way over optimistic projections for green energy and the reliability of green energy. It's overregulation of that Nord Stream 2 pipeline. It's relying too much on Russia. They get over half their natural gas from Russia. All these things come together, and net gas markets were tight already coming out of the pandemic the first time, prior to this. So this is a big deal. I actually think we're a little bit insulated from it. It looks like what our energy markets are telling us. Natural gas has come off quite a bit here. Crude is going higher, but I think crude is going higher based on demand. But I think the real important takeaway of this is that as we start making projections of what policy is going to be, I'm hoping that we can learn from other people's mistakes. And this is certainly a mistake. And I'm for green energy as it goes long term. You can't disrupt the market by trying to jam it in too quickly, or else you get things like this. This is a big deal, and this is a big deal in Europe, and it could lead to food shortages as well.
Wow. Well, that would be unfortunate. Well, we'll be watching that story. Let's look ahead to 2022, Kenny. Are you expecting some activity at year end just from portfolio shifts as you might see at year end? And what do you think in terms of those stocks that have been beaten up recently? Will we see a bounce back in the new year? How do you see 2022 shaping up?
So good morning, Maria, and Merry Christmas. I think a lot of the portfolio shifting from big asset managers has really mostly taken place at this point. We've got, 5 trading days left in the year or 6 trading days left in the year. So most portfolio managers have kind of closed up the book on that. They're walking away from their desks. They're leaving low ball bids in and high offers in just in case we get an erratic move one way or the other. But I think 2022, to Keith's point, is going to be a little bit turbulent in the first half of the year, right? All depending on what we hear from the Fed, how hawkish he becomes, which I think he's going to become more hawkish after he gets formally reappointed with the Senate vote. And that's, I think, is going to lead to some turbulence. And then people need to set themselves up. So I've been calling for kind of a more defensive posture, right? I'm not getting rid of my high growth names, my tech names. I bought Apple for a reason. That reason hasn't changed, so I'm not getting rid of it. And the same would be true for the other names in my holdings. But you might want to look at some of the names that have gotten really, really beaten up, names that did really well going into COVID. We know what they are. Zoom and Teladoc and Peloton and Roku all did very well going into COVID. Then this year have really, really underperformed. I mean, Peloton's down 140%. Now, maybe you can argue that it was way too high to begin with, but one way or the other, it's down 140%. The other ones are down around 40 to 50%. And I think some of that was kind of year-end tax selling. People were kind of getting out of those names ahead of the conversation about the Fed. But they're at a point now where if somebody wants to make a trade, they're looking at those names as a trade, not necessarily as a core holding. Because for me, none of those names would be a core holding, but they might be worth a trade if you want to allocate 5 or 7% of your portfolio, if that's how you invest, to names that have gotten
Yeah.
really beaten up because you might see a bounce.
Kenny, if we see 3 rate hikes by the Federal Reserve early first half of the year 2022, does that really create a competition for stocks? I mean, let's face it, these rates are coming off of such low levels that even after 3 hikes, you're still talking about low rates. But does that create a competition for people's money away from stocks? Do I say, well, I'm going to get this yield in treasuries, let me go here?
I think it's going to. Now, listen, we're expecting 3 hikes over the year of 25 basis points. That's what the market's expecting. My fear is that the Fed is behind the 8 ball on this. Inflation is going to be worse than what they say, which is why I think he's going to turn more hawkish. And what I'm afraid of is that the rate increases turn to 50 basis points, at least on one of those increases, and that'll be enough to shock inflation and shock the markets, and therefore then I think the markets will have to adjust. But one way or the other, it will start to offer some competition. They'll still be low, like you said, but the line will be drawn in the sand on which way they're going.
Yeah, good point. All right, Kenny Polcari, James Urio, and Keith Fitz-Gerald. Merry Christmas, gentlemen. Great to see you
Merry
all.
Christmas.
Thanks so much for the word on Wall Street and a great 2021 with us here at Mornings with Maria. Quick break coming up.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.